When you first start investing into ETFs, it can be a little overwhelming with all the different options you have available. So I'll walk you through the best ones to pick out based on your investing goals. You want to figure out your risk tolerance and the kind of returns that you want to make. The two main types of ETFs that you can buy are ones that give a nice consistent return, normally about 11%, and these tend to track the overall stock market. This includes ETFs like VOO and VTI. Then there's also growth ETFs that can have a far more impressive return, anywhere up to 16%, but they are a lot more volatile, so when the market isn't doing well, they tend to have a bigger drop in share price. Some of the main growth ETFs are VUG and QQQ. The reason these ETFs have a different performance in terms of how much money they make and how volatile they are is related to the type of companies included in the ETF. VOO and VTI have big stable businesses like Apple, Microsoft, Coca-Cola, big branded blue chip companies that have stood the test of time, and some of them are over 100 years old. Whereas VUG and QQQ have more speculative investments that tend to have better price performance when there's a bull run or the whole market is doing well, but they do drop a lot more when there's a bear run or there's not as much money in the market. So the first thing we'll jump into is the returns that you can make from these investments. So from a practical standpoint, what does it mean if you get an 11% return every year? Basically, every 6.5 years, you'll be able to double your money. Or if you were to invest $10,000 10 years ago with an average return of 11% per year, after those 10 years, you would have $28,394. Or if you had a bigger risk tolerance and invested in a growth ETF like QQQ, which has gone up on average 17% each year, it would take you 4.2 years to double your money. Or if you invested $10,000 10 years ago, your portfolio would be valued at $48,068. So there's definitely a big difference between investing in a growth ETF versus one that gives you a consistent return. On screen, you can see the blue line at the top, which is QQQ, that has gone up 408% in the past 10 years, in comparison to VOO, which is the orange line at the bottom, that's only gone up 203%, which makes QQQ look way better on paper. But if you take a look at the maximum drawdown or the max price that the ETF has lost in terms of its value, the most that it's dropped for QQQ is 83%, and for VOO it's only dropped 33%. So you do have the potential to make a better return with the growth ETF, but there's a huge potential as well to lose a lot more money depending on how consistent you are with holding on to the investment, and if you're happy to see your portfolio potentially have a drop as big as 83%. Because if you're investing for growth, it might be better to just outright pick a growth stock. So if you take a look at the 10-year returns for Tesla, which is the blue line at the top, it's gone up 2,678% versus VOO at the same amount of time. 10 years, which is the orange line at the bottom, it's only gone up 203%. So if you're picking out something for growth and high returns, it might be better to just go with the growth stock. And if you want consistency, then an ETF like VOO or VTI that tracks the whole stock market in general could be a better option if you just want that consistent and reliable return that's not going to really have too many price fluctuations with it. You can actually see for Tesla, its max drawdown was 10% better than QQQ. Tesla came down 73% and QQQ came down 83%. The second thing is that ETFs don't always make you money. Of course, in the long run, they are a consistent way to get a good return, and on average, the stock market will give you about 8 to 10%, but that's across a big time horizon, say 40 years. And you can see on this graph, the S&P 500, which is basically a representation of the whole stock market, it doesn't always go up in a straight line. There's lots of ups and downs along the way. Some years it might go up 10%, other years it might go down 20%, and other years it might just do nothing and move sideways for a long time as well. I always thought the normal ups and downs that came with the market were a bad thing, that you should only buy when the market is going up and you should always sell everything when the market is going down. You can see on the chart from 2014 to 2023, there's lots of ups and downs that the market has. Some years going up over 28% and other years coming down 20% as well. But if you average out all those returns through the good and the bad years, you'll get that return of about 8 to 10%. The third lesson is that ETFs are made made for passive investing. You're just participating in the market, and it's not the same as when you're investing into an individual company, which takes lots of research, time, and energy from your end, which is active investing. So with an individual company, you'll be researching the business's financials, looking at the management team, what are their plans to move the company forward, looking at all of the historical data and the financial reports about the business, so you can get a really good idea of what its plan is and how effective it'll be at growing your money. Versus with an ETF, you're just consistently adding the same amount of money every week or every month into that investment. You're just slowly building up your portfolio, and you're not trying to figure out the best time to buy and sell an ETF. The best strategy is to hold on to it for as long as you can and let that money grow and compound over time. You can see from this graph that there's always something going on in the world that has the potential to negatively affect the market. From global conflict, housing crisis, financial issues, pandemics, there's always something going on in the world that can affect what the stock market is doing. But even with all these things coming up since the 1950s and even before that as well, the market will give you a return of about 8 to 10%. So it's always about a long-term strategy and just consistently adding to your portfolio for better or for worse. When it comes to ETFs, you'll also need a place to buy them from as well. So I'll show you how to get zero fees for exchanging your currency and buying your shares using a special platform called Tiger Brokers. New users that sign up via the link in the description box will gain access to this exclusive offer. So firstly, you have to jump on the Tiger Brokers platform and search for the ETF or the stock that you're wanting to invest in. So I'll click on VOO, and here it is at the top. And then we just want to go to buy in the bottom left corner of the screen. So once you're here, make sure on coupon it says fee waiver card and have that selected, and then click on the amount that you're wanting to invest in. So I'll invest $10 into VOO, and then I'll click on buy. Then I'll click on place buy order at the bottom, and then the transaction is submitted. So we'll click on view order. So once you pay the brokerage fee, you'll receive a rebate, and that money will be refunded back into your account. So with this, 4 times each month, you'll be charged 0 brokerage fees for investing. Next, we'll be jumping into how to get 0 fees for exchanging your New Zealand dollar into the Australian or US dollar, or vice versa as well. So you can exchange up to 2,000 NZD into either of these currencies. So to do that, head over to your portfolio and then click on currency exchange and select the amount that you want to swap over. So I'll convert my $10 NZD into AUD. So you can see the initial foreign exchange fee that was charged, and then the rebate coming into effect to refund that money back into the user's account.